Whoa, Morningstar just made its rating systems even tougher. I came across this in Barron's the other day. This is interesting. Had a guy reach out to me. He wanted to interview me for some paper he does, and he said, "Hey, what do you think about Morningstar ratings changing?" I said, "I didn't know about it, so probably don't want to interview me." But let's take a look. Dateline July 8th, 2019, from Darren Fonda. All right. Earning a top seal of approval from Morningstar is about to get tougher. Morningstar announced on Monday that it's revising its mutual fund rating system, doubling down on fees and setting a higher bar for funds to earn the top stars of gold, silver, and bronze. The changes also apply to Morningstar's quantitative ratings, a system that uses machine learning techniques to rate funds that human analysts don't cover. Ratings changes will take effect on October 31st, 2019. Halloween! Scary! Morningstar is going to scare us. Fees are set to play a much bigger role in the revised system. Good. Under the current system, high fee funds that failed to beat the market index can still earn a high rating from Morningstar. That may be the result of several factors that aren't entirely intuitive. An analyst may approve of the fund's management process, for instance, the other pillars that Morningstar evaluates. Oh, I just these pillars: people, process, parent, performance, price. We used to do that at USAA, and all these firms do it. We have the 6 P's: people, process, performance, price, blah 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 blah. That's just so trite, so boilerplate. I just wish people in our industry could think of themselves one time. Everybody uses this 6 P's. They'll have these. I don't have a thing to show, but these little spreadsheets that are designed to solicit your business and investment management. This is what we're about. We're about our people. We're about our process. It's like everyone has that. Ugh. Anyway, the enhanced framework sets a higher bar for strategies to earn a gold, silver, or bronze rating, and we're placing a greater emphasis on the importance of fees, says this guy. Analysts will now evaluate a fund's strategy and performance before fees, aiming to assess a fund's value before operating expenses and other fees scrape away returns. Exactly. The new approach puts fees on the same plane as other elements of a fund's ratings. All right, so such as risk-adjusted returns. And share classes will finally make a difference. Thank goodness. Morningstar analysts now only evaluate one share class, even if a fund has multiple asset classes that can vary widely in their underlying expense ratios and total cost. High-fee share classes now earn the same analyst ratings as lower-fee classes, which are typically only available to institutional investors. That doesn't make any sense. High-fee share classes earn the same ratings as lower-fee share classes? Morningstar been doing that? That's dumb. It looks like it's raining out there. I was thinking about getting ready to go for a walk. Thankfully, the practice is ending. Analysts will soon evaluate such share class on its own, taking fees into account. And high fee funds that tack on 12B1 marketing fees or other expenses may be downgraded. Yeah, that's good. Morningstar expects fewer active strategies to earn a top rating under its new system. Analysts will limit medalist ratings, that's the gold, bronze, and silver, to active funds that beat their peer group and a market benchmark. Under the current system, funds could win a top rating by beating their peer or a benchmark, but not both. Separately, Morningstar is revising its fund sustainability ratings for environmental, social, and governance factors known as ESG. Under the current system, companies would be evaluated on a curve within their industry. That could result in a top-ranked oil company receiving the same ESG sustainability score as a top-ranked bank. But oil companies simply pose more ESG risks than banks, says Director of Sustainability from Morningstar. For example, Microsoft and Royal Dutch Shell both achieve some of the highest rankings on sustainability in their industries. But Microsoft's new ESG risk score would be 14.1, less than half of Shell's 33.7. That reflects the fact that the main risk for the software industry is data privacy and human capital. Isn't that funny? Because they're not creating CO2 emissions. They're not flying. They don't have their own corporate jets. They don't have their server farms. Interesting. While oil and gas producers face higher overall ESG risk because of their ongoing carbon emissions. So just remember the ESG, they're saying environmental, I don't even know what the S is, sustainable or something like that, but governments, environmental, social, and government. So what does that mean? All right, so we can say, let's just say it's for green. If you want to be green, this gives you the opportunity to say, I'm investing in green. Because remember, Google, they're fully green because they're a tech company. Tech companies are green, I tell you, green. Stupid. If you're invest, I mean, look, if you want to invest in more, I don't care. I literally don't. But I chuckle at that. The idea that Google and Microsoft and Amazon tech company. I mean, hell, Amazon. My goodness, we just got something delivered today from a UPS truck. How does that get here? Delivered from China. Yeah. The new system, I just don't care. The key thing to convey the ESG risk, and how do you risk governmental, social? How do you risk that? How do you judge that? Is China versus U.S.? I mean, hopefully, my goodness, China would receive a bad environmental grade, environmental and governmental. Yeah, but is Morningstar going to do that? It's nuts. All right, so anyway, let's talk about what the let's see what the comments are here. There's only one in here. Thoughtful. Let's see. This guy says, all right, all this would seem to be very good news, especially the bit about different ratings for different fund classes. Separately, Morningstar. Okay, I don't know what this is. I'm admitted to being glad about separately. All right, I don't know what that means. All right, so anyway, so gold. So what happens is you have the 5-star ratings. I think, 10% get the 5-star, 22.5% get 4, 3, 2, and 1. So to get the 5-star rating in Morningstar is literally the top 10. That's just a pass, though. What they do, they have these metal ratings, gold, silver, and bronze, which are what the analysts think will be the future, what they think will outperform gold, silver, and bronze. And the reason they're doing this inherently is because they know fees are the number one determination of future performance relative to its peers. I mean, so for Morningstar to sit there and say, if we want to look good, we're going to have to make sure that our analysts are giving gold, silver, and bronze ratings to funds that are going to outperform. And just lo and behold, it happens to coincide almost dollar for dollar with the lowest fees. I mean, it's just this huge correlation. The best performing funds or the lowest fees funds. It's literally that simple. Highest performing funds or the lowest performing funds have the highest fees. You cannot, if there's anything you can write book on in investing, that's it. So I imagine Morningstar's gold, silver, and bronze. I didn't even know about the freaking. I had no clue. I imagine it hasn't done much in the industry because they're like, yeah, you're not really doing that much for me in terms of a evaluation of future performance. Thus, I don't care. And they're going to say, now we're going to put more of an emphasis on fees because we all know fees drive results. That's all there is to it. They're 5-star funds, 4-star funds, and all that. Again, that what Morningstar say, well, that's backward looking. Our gold, bronze, and silver are forward looking. So, yeah, be honest, man, I thought it was interesting nonetheless. So, Morningstar is changing it to be more accommodating to fees. And I think that's a good thing. Not a big deal, but I thought it'd be interesting nonetheless because, again, to get a high rating at Morningstar, you're going to have low fees. There's no other way around that unless you are a barn burner, and there's just not that many that do it consistently. All right, we'll see you.